Hey everybody, we got to know a lot of stuff coming up here real quick. We've got tax law sunsets, meaning lots of taxation is going to change and we have to be prepared for that. So, do you know what's going to change and are you going to be prepared for it? Let's start with the estate tax exemption. 2017 Tax Cuts Jobs Act is expiring most of its stuff January 1st of 2026. And there's a reason we need to talk about that, because if you don't know about it, you should have been proactive in these last few years at this lower taxation. And part of this is the estate tax exemption. So before 2018, because 2017 is when they did this, 2018 is when it was implemented. The tax exemption for an estate was $5 million per person, $10 million for a married couple. By 2023, because of the inflation adjustments that they were putting in there, we are now at 12.92 per person. 25 million for a couple. Next year, they've already made the adjustment for inflation, 13.6 million, 27.2 million for married couple. But here's what changes. In 2026, they're projecting it's going to be about 7 million per person, not 13. It's going to be about 7 million per person. So we're going back to this original 5, but we're accounting for the inflation adjustments that they have done. So essentially, the estate tax exemption is being cut in half. So instead of looking at the 12, 13 million per person exemption and no big deal, you need to start paying attention to the 6, 7 million per person range. If you are anywhere near that range, this is something that we have to constantly be working on and working with to adjust your net worth. Through giving and other ways, you can transition some of this, especially with your annual gifting amounts. That doesn't mean it has to go to charities. You can give to anybody you want, your children included. So let's make sure that we're proactive. Let's make sure that we understand this is not a surprise coming. There are things that can be done, especially if you're in that 10, 12, 15, $20 million range. There are things you should be doing and considering now. The next one is the taxation for the rest of us, right? You got the 20 million plus type people that need to worry about those big inheritance taxes that are 40+%. We need to be careful of that. But the standard deduction is going to affect all of us. We have been in this world where even if you think you're itemizing, if you're in retirement, you're most likely not. So the standard deduction was moved so much higher. In 2023, this year, it's $13,850 for a single person, $27,000 for a married couple. Meaning, if you don't have enough to itemize to cover $13,000 for a single person, $27,000 for a married, then you're just going to take the standard deduction, which is the vast majority of people out there. Okay, 2024, again, you see those inflation adjustments. The IRS has already moved that up to $14,600 and $29,000 for the standard deduction for 2024. Well, once again, 2026, we have the expiration of these tax cuts, and part of that rearranging of the tax return was the standard deduction. They effectively doubled the standard deduction for those new tax rates since 2018, effective through 2026 or through 2025, ending January 1st of 2026. So you should be anticipating a standard deduction that's getting cut in half, going down to about $8,000. Again, they're going to undouble it and account for the inflation adjustments. So we'll be somewhere around $8,000 for single filers and $16,000 for joint filers, which means we need to be prepared for itemizing again. Some of us realized it and stopped worrying about it, stopped keeping track of it. And so as things stand today, our standard deduction is going to get cut in half, and we're going to have to start itemizing again. The next part I'm going to talk about more as a miscellaneous category. The whole itemizing section is going to change. So we restricted so much of the itemizing because they gave such a big standard deduction. And, you know, if there's anything that their lawmakers are going to jump in and try to keep, I'm kind of hoping they keep that higher standard deduction and the restrictions on the itemizing, because honestly, it just makes the world so much easier for the average person. Look, there's a lot of us out there, and some of you may be upset because you have really high state, home taxes and stuff like that. So state and local tax deduction, the limitations are going away. That's going to make a lot of people happy, because now those of you that live in high property tax states, that will help you on your tax return. But look, the vast majority of retirees, now I'm talking the sheer number of people, are not going to be affected by some of this stuff. Those that are great itemizers that live in states with lots of deductions, mortgage interest limitations relax. You can start deducting those second mortgages, those line of credits, all that kind of stuff again. The restriction on the amount of the mortgage it raises back up. Even from a gifting standpoint, charitable giving goes down to 50%. So you're not going to be able to give as much. And I've only run into one person giving more than 50% of their income away. But then there's, again, it's a double-edged sword for those people that are great at taking advantage of all these itemized deductions. The alternative minimum tax usually punishes you. So if you're deducting way too much stuff, you got a lot of maybe a big dividend portfolio, maybe you've got some municipal bonds in your portfolio, the alternative minimum tax is going to affect a lot more of you. So got to be careful about this. And then there's some business pass-through taxation, things like that, that will be eliminated as well. So miscellaneous category, there's 19 more of these. There's lots of these little things that a lot of people don't notice are going to be going away in 2026. So here's the big one. Tax rates are changing. So I told you about the standard deduction. Here's where we stand today, 2023, standard deduction for a single person, $13,000, standard deduction for a married couple, $27,000. And then you've got your tax rates, 10, 12, 22, 24, 32, 35, 37, and these are the thresholds for the top of each. So go over 58, you're going to start paying 22. And the big line here is low taxation, high taxation, all right? 2026, this is where, and it's hard to estimate because all of these numbers adjust, each one of these brackets adjust, but we're estimating the standard deduction goes down to about $8,000. So from a single person to, in 2023, down to a single person in 2026. And then the joint down to 16, double the single, obviously. And then you look at the tax brackets, we still have the same 10, but the 12 goes to 15, the 25 or 22 goes to 25, the 24 to 28, the 32 to 33, the 35 stays the same, and the top tax bracket gets a little bigger. So we will have higher taxation, but that reduction of standard deduction for some people is going to be more painful, right? That just means more money being taxed at higher tax rates. Look at the 58 versus the 52. So that's going to adjust us back down unless you can make up for it in those itemized deductions. So what do we need to do about this stuff? Well, first of all, when I talk about being proactive, that means that either you or your advisor needs to understand taxation and how that's going to affect you individually, because taxation is so sensitive and everybody's conversation is different. Everybody has a different amount of IRA money. Everybody has a different amount of non-qualified after-tax money. Everybody has different assets, different income, different everything. So either you or your advisor needs to understand taxation. And I'm not talking about your CPA. Your CPA does not want to sit down and strategize about adjustments in your portfolio. They don't talk about anything that has to do with investing because their lawyers have grounded into their head that you're not allowed to talk about investing. It's just the reality of it. And unfortunately, many advisors in the financial world say that they won't talk about taxation as well. And that's a big no-no. They have to be able to talk about taxes, especially from 10,000 feet. Should they be talking about how the intricacies of filing a tax return in Minnesota versus Arizona? And no, they shouldn't be getting into nitty-gritty detail like that, but certainly the big picture taxation, they should be talking about and making adjustments to their financial plan and your portfolio. Things like Roth conversions, tax loss harvesting. There's so many things that should be looked at. And even for the higher net worth people, looking at that total net worth, making sure that we're making adjustments and gifting properly before the time runs out. So keep your eye on the big picture. Don't just think about how do I pay the least amount of taxes this year. You should choose to pay taxes this year because things are going to get higher in taxation. I think most people admit we have to because our national debt is exploding and our budget is not balanced, and it doesn't matter who's in office, they're all spending too much. So go back to keeping track and itemizing your expenses because you have to be prepared for that. You have to be able to make sure that you're paying attention to all the little things that you can write off. Right now, it's very restrictive. You can write off very little. After that change starting in 2026, boom, you're going to be able to write off lots of stuff again. Understand the most common triggers for the alternative minimum tax are in your portfolio. Again, this is why your advisor, your financial advisor, your stockbroker, your whatever you want to call them, if it's yourself, either you or that person needs to understand taxation, because I've seen lots of portfolios that will trigger that alternative minimum tax, which is, I believe, 26% flat tax. And it's not pretty. And when you have municipal bonds or you've got a big dividend portfolio, sometimes this is, in certain circumstances, we haven't seen it in 10 years, but the reality is all of a sudden you're going to hit much higher taxation because of this. So be very careful about this. This is another reason why anybody putting investments in a portfolio needs to understand this type of taxation. All right, if I can help in any way, I love doing this. And weirdly, I'm one of those guys that enjoys taxes and talking about taxes and looking at the big picture. I'm the planner side of this world, and I do enjoy talking about these things. And it's a puzzle. Everybody's in a different situation. So certainly, if we can help in any way, give us a call, shoot us an email, like the video, share the video, subscribe to the channel if you haven't, and we'll see you next week.